Okay, hello everybody. I want to thank you for joining us today. I know everyone's time is very valuable, especially this time of year. So we're going to get going. It's 1 o'clock, and it looks like some folks will be joining us here as we go, which is okay. I'm going to introduce myself and the team. My name is Tom Helm. I'm an audit partner here at Anders, and presenting with me today are two lease experts. We have Leslie Sanchez, who is an audit principal, and Brian Losey, who's an audit manager. We're going to be talking about the accounting standard lease update, and this has been a long time coming. They've been talking about this for 10 plus years, and it's here. It's not going anywhere, and to our knowledge, it's not going to be extended for any future period. So it's going to be something that we all need to figure out how it's going to affect our organization. This standard is fairly large. It's not overly complex, but there's a lot of information which makes it challenging. So there is no way we're going to be able to talk to you about everything in the 1 hour time allotment that we have today. So we're going to break it down a little bit. First, we're going to talk about some key concepts and terminology, and then we're going to talk about the lessee side of accounting. And we felt like the majority of the standard changes were on the lessee side. We're going to go ahead and send some future content on the lessor side of accounting, the income tax effect, and some of the other nuances of the standard. And there are a lot of nuances and a lot of things that you have to understand. We were able to look at some of the questions that you guys submitted ahead of time. We really want to thank you for that. We incorporated those questions into our presentation. And for those of you who are publishing questions as we go, we will do our best to get to you if time allows at the end. And if we're not able to get to you, please feel free to reach out to Leslie, Brian, or I. Our contact information will be at the end of the presentation. And I suspect that we'll probably be asking for additional information. A lot of the questions you all are going to have is going to be very specific to your individual lease contracts, and all the answers are usually in the contracts themselves. So we'll be able to have those one-on-one conversations if we can't get to them today. The good news for everybody is we get 1 hour of CPE. So for all those who need CPE, you have to stay on for the duration of the presentation. And upon conclusion, we will send you your certificate for your records. I'm also told that we are recording this presentation, and we'll be sending it to you so you can forward it along to whoever you'd like. We have a lot to get to. We're very excited to be presenting in front of everyone today. And that being said, I'm going to kick it off to Leslie.
Good afternoon, everybody. Again, just like Tom said, thanks for joining us. So I'm going to go through some of the implementation and kind of overarching concepts of the standard. And then Brian's going to go through some examples. And then I will come back and we'll talk about some specific nuances that have a more global impact. And as Tom mentioned, there's nuances to the standard that are very probably limited in situations and circumstances. And so we will have additional content on those, but won't be addressing those today. So we get a lot of questions on what types of leases does the standard apply to? And the answer is all leases. So think of your most insignificant lease, such as a postage machine, to maybe your most significant lease. Real estate, is it building, land, and everything in between, vehicles, equipment. Essentially, it's any contract that gives you the right to use an asset over a specified period of time. And a period of time could also be, quantity of use, mileage on a vehicle, things of that nature. So really, you need to think about contracts that give you the right to an asset that you don't own, but over a period of time. Those are all included in this standard. This standard is going to be effective for any fiscal years beginning after December 15th of 2021. So for many companies, this is going to be January 1st, 2022. This standard is going to be applicable to your financial statements. Any fiscal years ending over that period that haven't started yet, this standard isn't applicable until that fiscal year starts. If you've got a July 1st fiscal year start or September 1st, those would be into 2022. Go to the next slide. So let's talk a little bit about how do I identify a contract that contains a lease. And the lease accounting standard gives us a nice little flow chart that is easy to follow with all the context of the standard. So first you want to consider, like I mentioned, do you have an asset? Have you been able to identify an asset in a contract that you are getting the right to use? Then let's think about, do you have the ability to obtain all the benefits from that asset? So while you're using it, while you have it, do you have full control of it over the entire period of use? The lessor can't take it back from you, things of that nature. And then we need to think about, do you as the customer, the lessee, or does the supplier, the lessor, have the right to identify how to direct the purpose and use of that asset? And if the supplier can direct that use to a certain extent, then you don't have a lease. You don't really have control of that lease. So a lot of this has to, flows around control. So let's talk about some examples. If we can go back to the previous slide, please. So the first example I'd like to talk about is rail cars. So you have a contract where you are given 10 rail cars for your use. The rail cars sit on your property when you're not using them. You can store items in them. Say you only need them, one time throughout the lease period. The rest of the time, you can use it as storage. So you are at that point obtaining substantially all of the economic benefits, and you are controlling the use of those rail cars. You have full control of them. When we're talking about potentially substitution rights on those rail cars, if we talk about that example and change it slightly, where a contract gives you the right to 10 rail cars, but those rail cars stay on the lessor's property. Essentially, when you need use of those rail cars, you call up the lessor or the supplier, the vendor, and say, I need to ship, X amount of items and I need access to 5 rail cars. The lessor can then use any of their rail cars. They might not be the same rail cars every time you need them. So that's what they call substitution rights. So if the vendor has the right to substitute the asset you're given with other assets, then you potentially do not have a lease in that situation. And then say the vendor tells you you have the right to control all of these rail cars. They sit on your property. The only thing you can do is you can't ship explosives in those rail cars. That's what's called protective rights. That doesn't necessarily mean that the vendor is controlling the use of those assets. You have to think about it in totality of the contract, but that's a small portion of the contract that they're using basically to protect the asset so that when you're done with it, they get back essentially what they gave you. And nothing happens to those rail cars and they don't need to be replaced. So let's think about another example, fiber optic cables. So a lot of times if a company needs use of fiber optic cables, they might say, okay, you can use up to X percentage of the capacity of the fiber optic cable, and another company or multiple other companies have the option to use, the remaining capacity. So in that case, you only have a portion of an asset. You don't have a full asset. And so you can't really control the use of that asset. So in that case, you might also not have a lease. So again, consider, do you have an identified asset? Can you control that asset? And then can the vendor doesn't have the ability to substitute it, the vendor doesn't have the ability to direct it, then you are going to have a lease contract most of the time. Let's go to the next slide, please. And then some other considerations after you've considered all of that. Do you have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? So again, they can't, it goes to control. They can't tell you how to use it. They can't change how you're using it. And then the last consideration is, was this asset designed for you? Did you work with the vendor to maybe develop a piece of equipment that's very specific for your use? And at the end of the lease, the vendor can't really do anything with that product. They can't sell it to somebody else. They can't lease it to somebody else. Basically, they can just maybe take it apart and use the parts. Then you probably have a lease as well, because you have full control. It's very much for your purposes or use. The vendor has no other ability for that contract. And then if at the end of the day, you determine that you don't have a lease, you would just account for those lease payments as expenses as you go through. So if you go through this whole process and you determine at the end of the analysis, you do not have a lease contract, it does not fall within this standard, then you're just recording your expense as you're making payments on the contract, and pretty much ignoring the rest of what we're going to go through next. So then let's move on and look at some accounting policy elections that you need to think about when you're going to implement this standard. Short-term leases, for example. Short-term leases can be excluded from this standard. You don't have to put the lease on your balance sheet, as Brian's going to walk through those examples and show you. Again, you can just continue to record it as you would an operating lease as you currently do under the current standard. But when you're thinking about short-term leases, these are 12 months or less, you have to consider renewal options. So if the lease is a 1-year lease, but at the end of every year you have the option to renew, and you think you're going to renew, then you might not have a short-term lease under the standard. So it's not just looking at 12-month leases, it's looking at 12-month leases plus options to extend and the term of the lease. So let's go to the next slide really quick and talk about determining the term of the lease and if it falls under the short term or if it's a longer term lease. So the term is the non-cancelable period of the lease. So you can't cancel it, the lessor can't cancel it for a certain amount of time without potentially a significant penalty. So you might have the option to terminate. You have a 10-year lease, you might have the option to terminate after 5 years. But if you terminate after 5 years, you have to pay 50% of what you would have paid for the remaining 5 years. That could be a significant penalty. And so if that's the case, then that option to terminate probably isn't considered in your lease term. Your lease term would be the full 10 years. So if we look at our options to extend, they need to be reasonably certain. If we look at our options to terminate by the lessee, you're reasonably certain not to exercise. So if you could terminate after 5 years and not pay a penalty, and you think you might actually do that, then your lease term might only be 5 years and not 10 years. And then the option to extend or not to terminate the lease at the option of the lessor. If the lessor has the option to terminate the lease at any point during the lease period, you aren't really considering that as the shorter of your lease period. So if the lessor only has options to terminate 5 years in a 10-year lease, you're not really considering that option. You're just looking at the lessee's option. So your lease would be 10 years. Okay, so let's go back and look at, we have some other accounting policy elections. Non-lease components. So as Brian's going to walk through how you measure your lease liability and your right of use asset, there's going to be various components or payments that you have to include in that calculation. Non-lease components generally are not included. So these would be things that you're paying that aren't really giving you the right to an asset. This might be, if you're in a real estate lease, this might be insurance and taxes on the property that you have to pay. However, you can make an accounting policy election to just include everything that you're paying under that lease. So you could include those, the insurance and taxes in the measurement of your lease liability, if you choose to do so. And keep in mind, these accounting policy elections, you generally have to make them over all your leases. You can't kind of pick and choose. And then another accounting policy election is your discount rate. When we walk through the examples, we're measuring our lease liability at a present value. And so in order to do that, you have to have a discount rate. A lot of times the rate used by the lessor to calculate their lease payments is not explicitly stated in the lease. So your discount rate, you want to look at, if you can determine implicitly what is in the lease, you can use that. You can use your incremental borrowing rate. So if you needed to go out and purchase this piece of equipment or the building, let's say, you could use the rate you could get on a loan. A lot of times people would, look at their current borrowing rates. If you're currently borrowing at the prime rate, then your incremental borrowing rate in determining the lease liability would be your prime rate. Private companies also have the option to use a risk-free rate. And you always want to use the rate in effect at the time that the lease starts. So if you use an incremental borrowing rate or you use a risk-free rate, that rate may be changing from month to month. You might have a variable portion of your rate. So you want to make sure that if you enter into the lease in September, that you're looking at what is the risk-free rate as of September, what is your incremental borrowing rate as of September. And then finally, we're going to talk about transition. How do we get all of these leases on our balance sheet and into our financial statements when we previously have not been doing so? And there's two approaches. There's a full retrospective approach and a modified retrospective approach. And there's also some practical expedients you can use to make the implementation a little bit simpler. So we're going to go into a little bit more detail on those. Next slide, please. Thank you. Next slide. Thanks. So on the transition, if you want to do the full retrospective approach, essentially what you're going to do is restate any period you're presenting in your financial statements as if you had always accounted for your leases under this standard. So a lot of companies, present a comparative financial statements, the current year and the prior year. So when you're presenting your 2022 financial statements, you'll show leased assets and leased liabilities. And in order to make the full retrospective approach, we got to make the prior year comparable. And so we would go back to January 1st of 2021 and determine how would we have accounted for these leases as of that date. And we would adjust our equity and we would adjust our balance sheet for those items. And so that way, when you're showing full retrospective, you're showing comparative years. Under our modified approach, you would only start recognizing the leases as of the earliest of the standard implementation date. So if you are in a calendar year, this would be as of January 1st, 2022. And if you showed comparative statements, you would show the leases on your balance sheet in 2022, but they would not show up on 2021. And in order to get them on your balance sheet, you're going to see an adjustment through your equity on your equity statement to offset what you put onto your balance sheet. So for those who have implemented revenue recognition the past couple years and had some of this presentation, it's very similar. And then there's some practical expedients you can use. These first three you have to implement as a package. So if you want to implement the first bullet, you need to implement the second two. So what it allows you to do is you don't need to reassess contracts to determine if they do or don't have a lease. If you determined it was a lease in 2021, it's a lease in 2022 when you implement, and vice versa. This might be because you might enter a contract that maybe there's a sales component to the contract and a lease component to the contract. And it might not be just a straightforward, you go lease a vehicle. So that's why they put this practical expedient in there, because there may be contracts that have multiple components that contain non-leases. You don't need to reassess classification. Brian's going to talk through how you determine the classification of the lease, but if it's an operating lease under the old standard, it's an operating lease under the new standard. If it's a capital lease under the old standard, it's a finance lease under the new standard. And then you don't have to reassess any initial direct costs. Brian's going to talk through how that impacts the measurement of the lease liability. And then this last bullet point, you don't have to implement with the other three, but you can use hindsight to determine your lease term. So when we talked about, are you going to execute that option to extend, you already know what's happened, so you can factor that into your analysis and your measurement. Okay. And now I'm going to hand it off to Brian, who's going to talk about classifying and measuring your leases.
Thanks, Leslie. As you mentioned, I'm going to take you through classifying and measuring the lease, and then I'm going to give you a couple just basic examples of each type of lease for the lessee. So under the new guidance, classification criteria is more of a principle-based approach, whereas under old guidance, we had some quantitative guidelines or thresholds to meet. This is more of a principles-based approach. So under the new standard, we have either a finance lease or an operating lease. There's 5 criteria for determining if it's a financing lease. If you meet one of those 5, then it's a financing lease. If you don't meet any, we're going with an operating lease. So the 5 criteria are transfer of ownership at the end of the lease term. So if you own the asset after the lease is over, you're hitting that criteria. Next is an option to purchase, and you have to be reasonably certain that you're going to elect that option to purchase. As the lessee, if you know going in, okay, at the end of this lease term, we're going to purchase, you're hitting that criteria. Next, the lease term is a major part of the economic life of the asset. So here we have 75% as a general rule in the implementation guidance. That's not a hard and fast rule. So if you're somewhere around 75% and you have, if you're a little under, you have good rationale behind why you think that's a major part, then you're meeting this criteria. Next, present value of lease payments plus the residual value is equal to or exceeds substantially all of the asset. So again, that 90%, that's not a hard and fast rule. It's just a guide of where you should be somewhere around. And then finally, if there's no alternative use at the end of the lease term. So if you have a customized asset that has no use other than what you're using it for at the end of the lease term, the lessor doesn't have the ability to do anything else with it, then you're probably meeting that criteria. So if you're meeting one of those 5, then it's a financing lease. If you're not meeting one of those 5, then you're going with an operating lease. What's that look like on the financial statements? On the operating lease side, on the balance sheet, we're going to have a right of use asset and a lease liability. On the income statement, we have the lease expense. So that's going to be exactly what we've seen before on the income statement. We're just classifying our payments under lease expense. And on the cash flow statement, we're presenting that in the operating activity section. On the finance side, again, on the balance sheet, we have a right of use asset and a lease liability. I'm going to take you through how we're measuring those in a bit. On the income statement side, we have amortization expense and interest expense. And on the financing side for the cash flow, we're going to have financing from activity and operating activity as well. So a little bit different on each one of those. 2 other things that I wanted to mention on our financial statement presentation, and if you can go to the next slide. The right of use asset and lease liability should be reported separately from other assets and liabilities. And we're going to want to show that either on the face of the financial statements or disclosed in the notes. So we want to make sure it's in one of those 2 places separately stated. And then finally, we're going to want to make sure that the right of use assets and the lease liability are going to be subject to the same considerations as other non-financial assets and liabilities when we're classifying them. So if you're presenting a classified balance sheet, we're going to want to calculate the long-term and current portions just like we would with some of those other non-financial assets. So how do I measure my assets, liabilities, and expense? So for the right of use asset, our initial measurement of the lease liability plus any payments made before commencement. So if you're making a down payment on the lease, that's going to be included. Less any incentives received. So if you're getting reimbursed for any leasehold improvements or build outs, any of those costs, those are going to be taken off of our asset, plus any initial direct costs. So if you have a piece of machinery that you have to transport to your location and you get some costs there, that's going to be included. So then our lease liability, that's going to be the present value of our lease payments not yet paid, and if applicable, any purchase option, penalty for early termination, amounts that are probable to be owed under a residual value guarantee. And that's going to be all discounted using the rate that's implicit in the lease. And as Leslie mentioned, if you can't figure out what that implicit rate is in the lease, then you can use your incremental borrowing rate for that. Two quick things I wanted to note on the lease liability side. Variable lease payments are not included in the measurement of the lease liability unless they're based on a rate or index. So if you have a variable lease payment that's based on a percentage of your sales, those are not going to be included. But if you have variable lease payments that are based on the consumer price index, those would be included. And then as Leslie mentioned, you can make the accounting policy for your non-lease components, whether to include or not to include. So whether or not you elect that is going to depend on how you're calculating those in your lease liability. On the lease expense, this is for operating leases. You're going to straight line that over the term of the lease. So you're going to want to consider if you have any rent-free periods, take your total expense and straight line that over the term of the lease. And your amortization expense for financing leases is again going to be straight lined, but it's going to be the earlier of your lease term or the economic life of the asset. So if your asset, the economic life is less than your lease term, you're going to want to choose that earlier period. So with that, I'm going to take you through two quick examples that are fairly basic, but really show you the accounting and journal entries that you'll be making. So in this example, we have an agreement with the lessor for a building. The term's 10 years with no renewal options. The payment is due December 31st, and it's $162,000. Our borrowing rate is 10%. Present value of our lease payments are $1 million. There's no direct costs. The economic life of the asset's 20 years. The fair value of the building is $2 million, and assets are transferred back at the end of the lease term. So evaluating our criteria, there's no transfer of ownership, there's no option to purchase, and it's a building, so we can assume that there's alternative use at the end of the lease term. The economic life is, or the lease period is 10 years, the economic life is 20 years. So that's 50%. We're not really anywhere near that 75% guidance. And our present value of the lease payments is $1 million. Estimated fair market value of the building is $2 million. So again, we're at that 50%, not really anywhere near that 90% guidance there. So we're not meeting any of the criteria. We're just going, this is a straight operating lease. So what does that look like? So on January 1 of year one, we're recording a right of use asset and a lease liability of $1 million. That's the present value of our lease payments, which is $162,000 at 10% for 10 years. $1 million, pretty easy calculation there. So then December 31st comes around, it's time to make our first lease payment and record our expense. So again, we're recording lease expense straight line over the course of the lease. So $162,745 every payment is going to hit the balance or income statement, sorry. Then we need to calculate, we're calculating some accrued interest that we're adding to the lease liability. And that's our value at the calculation date, our lease liability value, which right now is $1 million times 10% our rate gets us $100,000. So we're adding that to the lease liability, and then our right of use asset is decreased by the difference between those two. Now we're going to go and physically make that payment. So we're going to reduce our cash by the $162,000, and our lease liability is going to be reduced by that same amount. So then at the end of year one, our right of use asset is sitting at $937,000 and our lease liability is sitting at the same amount, $937,000. So then at the end of year two, again, our lease expense is going to be that same straight lined amount over the course of the lease. Our lease liability, we're adding to it the value at the calculation date. So at December 31st of year two, it's 937,000 times 10% gets us the 93,000. And then our right of use asset is the difference between those two. And then again, when we go to make that payment, we're reducing our cash, reducing our liability by that same amount. And at the end of year two, 868,000 is the balance of our right to use asset and lease liability. So you'll go through and make that over the course of the whole lease term. And again, that lease expense is going to be that same 162,000. That's going to be your income effect. So in the next example, this one is a little different. We're going to say we're leasing machinery. The period is for 15 years. The cost of the machinery is $1 million and it was purchased by the lessor on January 1. The economic life of the machinery is 15 years. So here we go. The economic life is 15 years. The lease period is 15 years. Those are equal. So that's hitting that threshold or that criteria for a financing lease right there. So we're going to say that the depreciation method is straight line, no residual value, use that 10% threshold again, and lease payments are $131,473. So the accounting for that on January 1 of year one is going to be a right of use asset of $1 million and a lease liability of $1 million. And again, that's your present value of lease payments, $131,000 annually at 10% for 15 years. So we're recording that asset and liability. On December 31st, now it's time to make our payment and record our expenses. Amortization expense, as I said earlier, is going to be straight lined. So $1 million is our initial calculation of our asset divided by 15 years gets us 66,000 annually. So that first part of that entry, the amortization expense and our reduction of the right of use asset is going to be the same for the whole 15 years of this lease. It's going to record the expense and reduce our right of use asset. The part that's going to change every year when we're making our payment is our interest expense calculation. So this is going to be our value of our lease liability times our rate gets us on year one that $100,000. Our cash payment was $131,000, so the lease liability is reduced by the difference between those two. So then you can see the balance at December 31st of year one, we have an asset of $933,000 and our liability is sitting at $968,000. Then when we go to make our entry for year two, amortization expense and right of use asset, that's going to be the same, as I mentioned, same over the whole 15 years. Our interest expense is now $96,000 as we're taking our lease liability balance times 10% gets us the $96,000 for this year. And our difference between our interest expense and cash out the door is our reduction of our lease liability. So at the end of year two, our right of use asset is sitting at $866,000 and lease liability is $933,000. So those will start coming closer and closer together as we're making it closer towards year 15. So again, those were two just basic examples. I wanted to take you through the accounting of those and let you see how that's going to impact the income statement and balance sheet. So you could get that visual. So with that, I'm going to turn it back over to Leslie to go over some other considerations.
Thanks, Brian. So the first thing I wanted to talk about is disclosures. It seems like with every new accounting standard lately, there's an extensive amount of additional disclosures that we are going to have to include in our financial statements. The disclosures for leases is no exception. They are very extensive. They can get very extensive. The reason being is there's a lot of information, quantitative information you have to disclose that wasn't previously required. And you also have to do this by type of lease. So if you have both operating and finance lease, you're going to have to disclose this information for operating leases and then disclose the information for financing leases, which is why it can get these disclosures can get pretty lengthy depending on your leasing activity. So what we need to look at is, again, we need a general description of the lease. Somewhat similar to what you had before, where you would say, you know, we're leasing a building, we're leasing equipment. But the things that they're adding to those qualitative disclosures are things such as, what are your lease terms? You know, we're leasing vehicles that range in a lease term from 3 to 5 years. You have to disclose your discount rates. What are your extension or termination clauses if you have them? What is the nature of your variable lease payments? As Brian mentioned, you know, there's a variety of ways that you could owe variable lease payments. So do you have variable lease payments? And if you do, what are they based on? If you have any residual value guarantees, restrictions or covenants in the lease agreement, you know, the lessor isn't allowing you to enter into other leases until you get their approval, things of that nature, if you would have those. And then you also have to disclose a lot of qualitative or quantitative information. You know, information that's embedded in your balance sheet, information that's embedded in your income statement and your cash flow statement. Future minimum lease payments, this isn't new. This is, you know, a disclosure that you've always had. If you've used any of those practical expedients we talked about, you have to disclose which ones you've used. And then any significant assumptions in determining if your contract contains a lease. You know, we talked about substitution rights, protective rights, partial assets, things of that nature. Did any of that, was it maybe not black and white in the contract, and you had to make some assumptions in quantifying that information to determine if you have a lease? So I'm going to show you a kind of what your disclosures might look like, and this is, again, breaking down the quantitative information. As you can see, you have a breakdown of your lease costs. If you have finance lease, what is your amortization expense? What is your interest expense? If you're operating lease, what is your operating lease costs? And these would be your fixed costs, because you need to break out the variable portion. As Brian mentioned, you don't include those variable lease payments for the most part in the calculation of your lease liability. So when you make those monthly entries or yearly entries, however you make them according to the lease term, that would be your operating lease costs. And then anything extra you have to pay because of variability, we have to break that out separately. And then if you have sublease income, you have to break that out. And if we go to the next slide, we have some even more quantitative information. So, you know, if you have sale leaseback transactions, where's the cash flow sitting on your cash flow statement? What are in your operating cash flows? Before, if you had a capital lease, you know, those would show up in your financing cash flows on your cash flow statement. But now they want to get a step further and say, what are your lease payments included in your operating cash flows? And again, break those out by type of lease. Talking about weighted average lease terms. So if you have 100 leases and they all have different lease terms at the end of a year, what is your weighted average lease term? And then what is your weighted average discount rate? So it's giving a lot of information, a lot of quantitative information. And so it's really important that and we'll talk about this a little bit at the end, but when you're structuring how you're going to account for these, how you're keeping track of these leases, keep in mind all of this information that is going to need to go in the disclosures and what's the best way to track it and keep track of that. Related party leases. We get a lot of questions about this. You know, related party leases shouldn't be treated any different than a lease with an unrelated party. So it follows the legally enforceable terms of the contract. If it was an unrelated party and you would account for it as a short-term lease, it'd be a short-term lease. If it was, you know, with an unrelated party and would be an operating lease, you would account for it as an operating lease. So there is no distinction for related party leases. What I do want to point out, and something to just keep in mind, if someone, let's say, wants to structure a lease contract with a related party to get a certain type of accounting in their financial statements, say it's for a building if you put any significant leasehold improvements into the leased asset, and according to the lease contract, it's a short-term lease, you would have to expense all of those leasehold improvements when you put them in place. So under GAAP, leasehold improvements are amortized over the shorter of the life of the asset or the lease term. So in this case, if it's a short-term lease, it would be only a year. And so you would expense all those leasehold improvements as you incur them. So that's just something to keep in mind if you're thinking about maybe restructuring some lease contracts. So you would qualify for short-term lease treatment or some other lease treatment. Say you want to make it just a 5-year lease. Again, if you put in a bunch of leasehold improvements, you're only going to be able to amortize those over 5 years, assuming the life of those assets is longer. Subleases. This is not uncommon. You lease a significant warehouse space, and after some time you realize, hey, I don't need all of this space, but I'm in a 10-year lease contract. So you're able to sublease a portion of it. If your sublease is classified as an operating lease, then you continue to account for the original lease just as you did before. You would measure your lease, your right of use asset and your lease liability when you enter into the original lease. When you enter into the sublease, nothing changes with that right of use asset and lease liability on your balance sheet, and you continue to make those same entries just as Brian walked through every month or year as you make your payments. If the sublease is a sales type or direct financing, and the original lease is a finance lease, so the lease you entered into with your lessor is a finance lease, and then when you go to lease the asset to somebody else, or lease a portion of the asset to somebody else, and it would be classified as a sales type or direct financing lease under the lessor accounting guidance, you would de-recognize your right of use asset on the balance sheet, but you would continue to account for your lease liability as you did before. And again, just follow the same transactions as Brian walked through. And if your sublease, can we go back one slide? Yes, thank you. If your sublease is a sales type or direct financing, but your original lease is operating, again, you would de-recognize your right of use asset and account for the lease liability in accordance with the finance lease accounting, which is a little bit different because you had an operating lease to begin with. Sale leaseback. So this is a little bit different than previous guidance. Previous guidance allowed or had you defer any gain on the sale leaseback over the lease term. So you sell your building, you lease it back, you sold the building for a gain of 10 million, and your lease term, when you lease it back, is 10 years, you'd recognize $1 million of that gain every year. Under the new standard, under the new leasing standard, you can recognize the entire gain at the transaction date of the sale leaseback, assuming when you enter into that lease contract, it would qualify or would be classified under the operating lease guidance. And then also the original sale would meet the definition of a contract under the revenue recognition guidance of ASC 606. If those two aren't met, then you would need to defer the gain as you did previously, but a little bit different than the previous guidance. Modifications. So, contract modifications aren't uncommon. You enter and you negotiate a shorter term lease, you negotiate lesser rent. Those would all be lease modifications. So something that's changing on your lease. What you need to do when you enter into a lease modification is determine, am I just modifying the existing lease, or am I really entering into a new contract for a separate lease asset? So if the lease modification grants you access to an additional right of use asset and your lease payments on that new contract would be at the market rate, then you have a separate contract. and you continue to account for the previous lease as you did before. And then when you enter into that lease modification, it's just like a new lease contract, and you again measure your right of use asset and lease liability. So think about if you have, you're leasing a portion of a building, and then you have the option to lease the rest of the building. That gives you access to an additional asset. If you are leasing the rest of that building at market rate, then you're doing it at the standalone price. If they're giving you a discount on it, then you potentially are not leasing it at a standalone price. And so you might not have a separate contract in that situation. And if you don't have a separate contract, then you need to reassess and remeasure your right of use asset and lease liability as of the modification date. Master leasing arrangements, these aren't uncommon with vehicle leases or equipment leases where you enter into a master leasing agreement that allows you the right to additional assets throughout a period of time. If the contract specifies the number of units you have to lease or dollar value of the lease, then each new asset that you take on during that period, say each new vehicle that you lease, would not be a separate contract accounted for, as we talked about in the first bullet point. You would have to determine you'd have to determine an allocation of the original lease at the beginning of the master lease agreement, and essentially each breaking out a component of what you have to pay to each future required piece of new vehicle. However, if it doesn't give you a minimum and it's just a master leasing arrangement that covers any new leases, and each time you go in and you get a new vehicle and it's at standalone market prices, then you would have a separate contract and each new vehicle would be accounted for separately. So what now? Where do we go from here? So the new standard is going to be effective, like we talked about, coming up in your fiscal year beginning after December 15th of 2021. So you need to start getting a handle on what are your current leases, especially if you have a significant number of them. You want to create a listing of those. You want to understand what are all those leases, what are the terms of those leases? Do you have extension options? What are you paying? Everything that we talked about, you want to have an understanding. And then we have to start tracking these. So, how do you track them? Because you have to, as Brian went through those examples, and as we talked about in the disclosures, there's all this information that you're going to need. You could do it in Excel. That's perfectly acceptable option. Creating formulas to determine your monthly or yearly transactions. Quantifying the disclosure information. Anders, if you're a client of Anders, we will be reaching out to all of our clients for a software that we are going to have access to that does a lot of this for you. So really, you're just looking at putting in your inputs, and then it would give you the disclosure information. It would quantify your journal entries. And so a software can make this process a lot easier. But that is a decision for each company to make. But obviously, the more assets the more leases you have, the more complicated this could be. So you also want to look at, do you have somebody currently on your staff that can track this information? Depending on the number of leases you have, this could be a significant task. And so you want to look at the capacity that you currently have in your staff as well. And then you want to look at your processes and procedures going forward. So anytime you enter into a new contract, what is your process for determining and evaluating if that contract contains a lease or not? You want to have some process procedures in place so that you don't miss a lease as you implement the standard going forward. And then how do I explain these changes to the users? So if you have investors or you're giving the information to your bank, in some cases you might be adding a significant, it could be millions of dollars in assets and liabilities to your balance sheet. This really, the economics of your business regarding these leases hasn't changed. So it's the same payments you required to do and you were required to make before. This information has always been disclosed in the financial statements under the future minimum lease payments. What we're doing is really just putting it on the balance sheet. So the economics of the transaction haven't really changed. It's the financial reporting of the transaction. And I think with that, I'm going to hand it back to Tom to follow up on any questions.
All right. So we do have some time for some questions. We've been answering some of them as we go. Someone asked if we feel like using a software will be easier if we're recommending it. We're not necessarily sponsoring any sort of software, but what we will say is it is absolutely going to be easier to track, especially if you have lease modifications. The software is able to account for those pretty easily. And you saw that laundry list of disclosures that Leslie brought up, and with the push of a button, it gives you all the information you need. So I can't say that you have to. Using Excel spreadsheets could work. I think it's going to be cumbersome, especially if you have 10 plus leases. We use fixed asset software because it's easier to track than Excel. I would say that would be the same philosophy for using lease software, and some of the capabilities that it has is pretty impressive. A few other people had asked me about loan covenants, and is this going to affect our loan covenants? Well, in GAAP, I'll give you the answer that's always given to me. It almost always depends. So you basically have to go to your covenants, you have to go to the applicable section, look at your ratios, and if you have certain leverage ratios or current ratios, because you're adding some short-term leases in addition to your long-term leases, which is the other side of your right to use asset, you could fail some of them. So you have to be proactive. I would calculate those ratios as soon as you can. I don't imagine EBITDA is going to change too much with this new standard, but I would reach out to your banker as soon as possible and talk to them. And if you do, if you're close or if you fail them, get a waiver or see if you can't get a lease modification. And I wouldn't assume that your banker is very familiar with this standard. It's new to everybody. We're all learning it. Just like Leslie says, you're going to get a lot of questions from your board members, from your investors. As far as you're concerned, you haven't done anything different than you've done for the last 10 years. Now, all of a sudden, there's these huge assets and liabilities on the books. So there are going to be some people that are curious as to why that's happening. Another quick question, it looks like a lot of people are actually asking about income taxes. And I'm very aware that everyone wants to know the income tax approach of all these GAAP changes. And what I will say, I'm going to send out some additional information in greater detail. But just because GAAP changed how you present leases, there were no IRS rules or regulations changed on the taxation or what you can deduct for leases. So you will have some book tax differences. You could possibly have some temporary differences for our C Corps out there to have some deferred tax assets and liabilities. So be aware of the book changes and talk to your tax preparers and your tax group to see how that's going to affect your tax returns. There was another question out here that I'll kick off to Leslie. They're basically asking for our fiscal year, a calendar year end, and we're adopting the modified approach. Are we supposed to make our cumulative adjustment to retained earnings as of 1/1 of 2022?